you like to sing. Think happy, and life's a happy thing. Think hopscotch, think chipmunks, think puppets on a string. Think happy, and life's a happy thing.
Hi everyone. I don't want to get into specific market predictions, but I think it's no secret that I've been getting more bearish as this rally's been progressing, and well, we are coming into a period where they say sell in May, and although it doesn't work every year, 2009 might just be the year when that comes right again. We've got the bank stress tests being announced. God only knows what's going to happen there. Various things. I mean, we just don't know. But I'd like to make a suggestion on the grounds of common sense, not market timing. And it's this: if you've got stocks with a hefty profit in, let's say that you bought nicely 5 or 6 weeks ago and you've now got a stock which has a $10 profit in it, I strongly suggest that right now is the time to sell that stock and put maybe, I don't know, depending on the price of the call options, $2 into a call option instead, which means that your risk is limited to the $2 you've paid for the call option, but you've still got a dog in the race. You've still got unlimited upside should that stock go crazy from here. So let's look at an example of call option in that scenario, just for people who aren't familiar with options. This chart is set to display the stock price along the bottom scale, and along the left scale is the profit and loss on the entire position that you've got. So let's look at that in terms of just buying stock, and let's say you paid exactly $50 for the stock. Well, obviously, if the stock went down to $45, you've made a $5 loss. If it went up to $55, you've made a $5 profit. How does that compare to a $50 strike call option, or indeed stock with a $50 strike put option? But the risk profile is the same, but as I say, I want to talk about calls in this example. So we get a shape like this. The blue circle indicates that the upside is unlimited. If you look at the red line, that's indicating the area where you make a loss, because the stock needs to make the $2 premium back that you paid. In a little more detail here. So the potential for loss is limited to the premium paid for the option. So if a $2 premium was paid for the option, then break-even is $2 higher than the strike price, and the maximum loss is limited to $2. So going back to the example of a $10 profit, let's say that you had bought a stock at 40 and it's now gone up to 50 and you've got a $10 profit. You sell it and you buy call options for $2 per share. So you've banked an $8 profit and you've now got $2 left in the race. If the stock continued up to say 60, that would give you another $10 profit, but you've paid $2 for the call option. So you can see that you can still participate in the upside, but at the end of the day, you're going to come out of that stock with the $8 profit that you've already banked. Now, you know, you could hold on to the stock, and I know it's very tempting, particularly if it's a stock which pays a dividend. But how would you feel if it went back to the lows of 6 or 7 weeks ago? For me, it's just not worth the risk of the pain and regret. And in this example, if I had a $10 profit in a stock, this is what I'd do. I'd sell it and I'd buy a call option for a couple of dollars and get myself through May, certainly through the next month or so. That's the point. And if you think, nah, it'll be all right, I'll just bide my time, and you know, it's a good stock. It's a good stock. Well, let's have a look at one stock in particular. This is Dry Ships. Late last year, it was trading at $80, and it dropped over a period of a couple of months down to $3. From $80 to $3. It bounced back up over the next few weeks to 18. Woohoo! It's now back down close to 3. Oh well, it's up to you, but that's my suggestion. Change your profitable stocks to calls, or just, I don't know, think happy.
Think popcorn, think picnics, think songs you like to sing. Think happy, and life's a happy thing.